Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's Under the Lens video, I'd like to further expand from a macroeconomic perspective on a recently posted September long wave video. I would like to discuss a macro view of what is happening in global markets. As such, I'd like to cover those items shown here. We have witnessed in 2019 almost all central banks and countries abruptly reversing monetary policy from a tightening bias to one of easing. Like lemmings, they have all followed each other as the slowing global economy has become increasingly more evident. The questions that need to be answered, but the media seems to ignore, are: 1. Why, after a decade, that is, since the financial crisis, has the recovery, which has been historically very weak, resulted in further significant stimulus now being required? Secondly, was the cause of the financial crisis actually correctly determined, and were the policy responses therefore actually correct? Third, do we realistically recognize and understand what the current economic problem with slowing growth rates are? Is it cyclical or structural? In our recent September long wave, we talked briefly about how slowing economic growth has put us on the path to corporate buybacks and shrinking stock pools, which is contributing to the Minsky melt-up we've been laying out in our videos for a few years now. This melt-up hasn't, nor will it continue to happen without market pullbacks. This should be fully expected. This MATA SII chart from our Triggers Technical Analysis offering has identified the path and expected pullback areas we should likely expect. They are associated with Fibonacci levels and various concurrent rising channels. They have played out perfectly so far. Though we are expecting a pullback in Q4 2019, possibly early 2020, we feel we have more to go before the melt-up is finally over. We need to expand on some of the ideas put forward in the September long wave video to show why this path is almost completely now locked in due to the macroeconomic parameters now set in motion. This generic cycle of change model is a good illustrative starting point. When something acts as a macroeconomic change agent, it leads to various economic policy responses, whether fiscal, monetary, or public. This in turn leads to adoption and adjustments by consumers, corporations, lenders, and societal norms and expectations. The behavioral response, if sustained, inevitably lead over time to structural responses in our global economies. At some point, these structural responses must be and are tested to see if they foster a stable and self-correcting environment, or are they fundamentally unbalanced and in turn lead to instability and even possibly worse outcomes. This cycle is normal and is to be expected if viewed in the right context. Let's put some context to the cycle of change which we believe we are presently in. The reality of slowing real rate of global economic growth has led the global economy into an era of unsound money, which in turn has led to impairment of the mechanic of working capitalism. We have long held this will potentially lead to the inevitable failure of fiat currencies. This doesn't mean the world will collapse, but as we laid out in our 2018 thesis paper, A New World Order, is highly likely in the future as a consequence. I'd like to trace this cycle of expected change through its four quadrants, starting with the upper right quadrant, to illustrate how much of what we see occurring fits as a logical consequence of the ongoing slowing global real rate of economic growth and expected change that is occurring as a result. As a society, we have failed to recognize this as a massive destabilizing force, that it is secular and not cyclical. It is uncoordinated regarding any sort of effective global response. All of this over time has led to the larger economic killer, and that is unsound money. In our 111-page 2017 thesis paper, The Illusion of Growth, When Leverage Fails, we laid out the undeniable fact of slowing real global economic growth rates, The first and second derivatives of this trend are having profound impacts. Superficially, global economic growth has been rising since 1980. We will come back to that critically important inflection date in a moment, with a major spurt after China entered the WTO. But as we laid out in the 2017 thesis paper, the whole formula for real GDP is hopelessly flawed in today's society, from the inflation deflators being used, to growth in government contributions through massive debt increases, to consumption through government transfer payments and entitlements. For the sake of time, I'll leave you to read the thesis paper on the MATA SII site. The reality is, without factoring in all the flaws in the formula since the 2008 financial crisis, even the official GDP numbers are falling at unprecedented levels, the result of public policy initiated being unable to fix the problems. The 3-year annualized real GDP leading up to the 2008 financial crisis makes this quite clear. It has only deteriorated further despite what is now approaching a $30 trillion level of artificial money and stimulus injections. Wages and salaries as a percentage of GDP steadily also weakened into the 2008 financial crisis. All of this leading to unprecedented massive inequality, something not seen in modern times and certainly going to be a societal problem going forward, as if it isn't already. What you may have noticed so far is 3 cusps in this part of our cycle of change. From Volcker's 1980 cusp to the 2000 dot-com bubble implosion cusp to the 2008 financial crisis cusp, and then to today. Each era brought with it unprecedented monetary, fiscal, and public policy responses. This slide shows how dramatic the liftoff in financial asset growth as a percentage of GDP has been since that 1980 date. Something significant occurred here, besides Volcker taking the Fed funds rate to historic levels to halt inflation and stagflation. We can see for a while after the 1980 cusp that U.S. productivity initially grew with the growth in financial assets before separating. We can see here the 2000 and 2008 cusps, which allowed further stimulus attempts at productivity growth. However, U.S. median household income separated quickly in the early 90s as corporate profits were maintained by returning less to workers in terms of total wages and benefits. This slide is a little busy, but it best illustrates the bigger picture at play during this period of the cycle of change. Up to the 1980 cusp, population and energy consumption per capita growth was helping drive rising living standards. As a consequence, rates were rising along with increasing money supply. Corporations and investors were seeing increasing total real investment returns. Savings in the form of corporate profits and public savings were strong and were being invested into productive assets. As a result, and as we saw, productivity was increasing. Rising worker wages and benefits resulted in rising standards of living across the income distribution. However, in the late 60s, due to the debt from President Johnson's Great Society and the Vietnam War, the U.S. was forced by August 1972, under President Richard Nixon, to remove itself from the gold standard. In the 70s, mounting foreign debt levels due to export powers like Japan emerging, the international balance of payment systems had to be changed from being settled in gold to being settled via credit. This was a profound change to the entire global economic system that the public didn't appreciate, I think, even fundamentally. We saw in an earlier slide the dramatic growth in financial assets as a percentage of GDP after 1980. After 1980, interest rates were steadily lowered as the real rate of growth slowed and total returns were maintained effectively through lower interest rates. Reduced interest rates increased consumption and reduced corporate costs. Worker wage growth and benefits were steadily reduced by corporations. Governments increased debt, and with it transfer payments to the public to maintain consumption. Employment and jobs got tighter and shifted towards a non-productive financialization of the economy. Since 2008, the global Dow 150 has in reality barely been able to maintain its 2008 levels. Savings have been replaced by debt, both for the public and corporations, all in an increasingly more difficult attempt to maintain profits by corporations and standards of living by the public. With savings shrinking, there is less money for investment in productive assets. Even more problematic with behavioral shifts was the investment in non-productive assets or financial engineering. Shown by the red arrows on the right, from 1980 until 2000, we had debt explosion fostering the illusion of growth. From 2000 on, we've had easy credit doing the job, both fostered through relentless falling interest rates. Behind the scenes, we grew a gap between real disposable income and the cost of living. This gap has increasingly been filled by consumer credit per capita. All three stages had different personalities, but the same low interest rate, debt growth, unproductive investment of financials marked them all. Returning to our cycle of change, we see that throughout this era we had failed policy responses around the world with various forms of responses, whether QE in the US, QQE in Japan, TLTRO in the EU, etc. Consumers, corporations, and governments all responded differently in uncoordinated fashions because of effectively addressing symptoms versus the underlying problem. What we saw in aggregate was what we have often referred to as monetary malpractice. A path we laid out after the 2000 financial crisis that we felt strongly would lead to malinvestment, dysfunctional markets, and delusional investments. Frankly, we are there now, and it will get worse. The malinvestment and leverage currently built into the global financial assets is unprecedented and not fully tested under stress. Every time there is the potential of a real stability test, new, untested monetary policy initiatives are launched, along with fiscal and public policy changes. You can always count on the government to change the rules, change the regulations, or change the laws when problems arise. It's like playing a game, and every time your opponent is losing, all the rules are changed. In 1980, it was the global balances being settled by credit. In 2008, it was the mark-to-market methodology, and the list can go on, just to name a few. What is currently happening is that the debt growth or stimulus spending is no longer delivering economic growth. It has plummeted and been negative for some time. This is a global problem and is making monetary policy simply ineffective. Velocity of money steadily worsens as proof of this. This has led us to the third quadrant, where we now actually unwittingly have impaired capitalism. We no longer are operating in a capitalist system, but a hybrid that can best be described as creditism. In a capitalist system, savings and investment are the primary drivers. In a creditism system, credit and consumptions are the drivers. The former is self-sustainable. The latter is unsustainable without a complete redesign of the global economic system currently operating. The latter has yet to be tested. We are currently sustaining creditism through debt-financed corporate buybacks, which are elevating financial assets. Buybacks and M&A via corporations are there versus investment by the public, and all sorts of financial market gamesmanship, referred to collectively as simply financial engineering. And as we pointed out in the latest long wave, it is leading to less risk-taking and more about capturing and preying on others versus generic and innovative corporate growth strategy that they are finding simply not there at real rate levels. This will go on for a while. The Minsky melt-up is still underway. We see 3,600 to 3,700 and possibly higher before the system actually experiences or is forced to experience a stress test that cannot be held at bay by any monetary, fiscal, and public policy reactions. Those policy initiatives will have run their course and will no longer be accepted by the public and investors. The likely test will most likely show itself as a fiat currency crisis. We are already seeing many of the building blocks for such a test, such as de-dollarization, which we outlined in our 2019 thesis paper, or currency wars and financial repression, which we showed in earlier thesis papers. The next corrective consolidation is likely to appear violent, but is likely to be nothing more than a move towards a trend line that is still going parabolic. If all of this seems like conjecture, I suggest you revisit your first-year calculus course on first and second degree derivatives. Things can appear fine until they suddenly reverse. The rates of change warn you well in advance. We've been getting these changes in derivative rates steadily for some years now. Consider yourself having been warned. As always, I remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That date is still well in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react or be forced to react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of unsound money and fiat currencies. I'd like to take a moment as a reminder, do not trade from any of these slides. They are simply for educational and discussion purposes only. Thank you for listening, and until next month, may 2019 turn out to be an outstanding investment year for you and your family. I sincerely thank you for listening.